And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Danny's going to join me today. We're going to be talking a little bit about annuities, the good, the bad, and the ugly. I've been getting a lot of emails lately asking about annuities, and it's interesting because annuities are fine if they're used properly. But I'm getting a lot of email questions lately talking about equity indexed annuities or just annuities in general that have a promise of 7% returns, and there's been a lot of ads on radio stations lately, and this occurs whenever markets are just kind of rocketing higher. People that are not in the markets trying to figure out how to get in the markets, but they don't want to lose money, and so these annuities, they promise 7% returns with no downside risk, and that sounds pretty good until you get into the details. And so we'll get into those details this morning, and we'll go through, is an annuity good for you? I have had for the last 30 years, I own an annuity personally, right, for a reason. But I have rules around owning annuities. So we'll go through those today with you and see if they might be a good fit for you. But we'll talk about just kind of the ins and outs of them. Also, we've got to get into a little bit about the market as we get ready to wrap up the end of the year. Danny and I'll visit on that as well. But today, of course, is inflation day, right? So it's the CPI inflation day. Headlines expected to come in at 0.2%. That's always what the expectation is. As we talked about before, the long-term norm since the turn of the century, the long-term average of inflation since 2000 has been 2.4%. So 0.2 a month, 12 months, 2.4%. That's why it's always 0.2. So 0.2% at the headline, 0.3% at the core. It's very possible we might see a little bit hotter print today. It's not going to matter much. It'll matter to the markets, but it's not going to change the variable of inflation or the trend of inflation. As we talked about before, if we just print 0.2% this month, next month, January, February, we're going to see the overall inflation rate rise because of year-over-year comparisons, right? So when we look at CPI, it's like CPI was 2.4%, right, or 2.5%. Well, that's the year-over-year comparison. What was it this month versus this month last year? That's the percentage difference. So we'll likely see that if we print 0.2 every month, we're going to see inflation rise here a little bit because of the year-over-year comparison. However, at 0.2% a month in April, we will be at 2% inflation because of that year-over-year comparison. So again, it's all the mathematical stuff. But you're going to see a lot of headlines out today talking about it, and it's like, oh, inflation's coming roaring back. If it's 0.2 or 0.3, and first of all, inflation's a guess. Nobody really knows. It's just kind of an estimate. Inflation in New York is very different than Texas or California. But again, this is just kind of a rough estimate. And again, as always, it's what the market looks at, what the market cares about. So that's why we pay attention to it. But I wouldn't read a whole lot more into that other than that. Here's the big impact, though, from inflation today. If the number comes in hotter than expected, which is expected right now, the markets are expecting inflation to print a little bit hot today at a 0.3% versus 0.2%. That's why futures are down on the markets this morning. Also, futures are down because we've had basically a huge rally since the election. So again, overbought on multiple levels, pulling back here a bit, not surprising. But a hotter than expected inflation number could certainly pull the market price down here a bit as expectation for Fed rate cuts, the Fed not cutting rates in December will start to go up a bit. Weaker than expected print this morning for some reason. And there is a potential for a weaker than expected inflation print because of oil prices. Oil prices have been declining here lately, and that's certainly going to weigh on the inflation print. There's a very high correlation between oil prices short term and inflation. So again, we could see a little bit of a weaker inflation print this morning because of oil prices, but we also have offsets from health insurance and cars and other stuff. So again, I have no idea where it's going to be. We'll find out. But a weaker than expected inflation print will certainly send markets higher today. So again, it's, all eyes are just 7:30 this morning. It's going to be all about inflation. So we'll see where we go from here. Let's talk a little bit about the markets. Here's what you need to know before the bell this morning. As you know, lately it's been just a rocket ship of a ride for markets. Stocks have been surging higher, not just on the S&P, but on the Russell 2000 index as well, the NASDAQ. It's just been a very strong rally for stocks. Stocks got very overbought, as we talked about yesterday a bit. And again, just when you have these big deviations from moving averages, and that happened very quickly, the market rocketed up. We got very deviated from the 50-day moving average. As we've talked about before, that those moving averages just simply act as a little bit of gravity. That's it. And so they're going to try to pull prices back down a bit. And so we saw the market sell off just a little bit yesterday. This morning, futures are pointing lower. Right now, the NASDAQ's down about 44 points for the open. The Dow's down about 115. So we'll see a little bit of weakness here at the open. But again, a weak inflation print can certainly reverse that this morning. So again, don't read too much into futures at the moment. It's all just pre-positioning right now for that inflation number. But we are very overbought on a relative strength basis, which is going to limit upside here near term. So again, not surprisingly, as we talked about previously, we're going to see a little bit of volatility going into Thanksgiving, a rally after Thanksgiving, and then some more volatility the first couple of weeks of December. Then we get the Santa Claus rally into year-end. So the markets will likely be higher. I took a poll on Twitter day before yesterday, and our year-end target for the S&P was 6,000. We had set that earlier this year. So again, with our year-end target met already, I put it out a poll. I said, what should my new target be for the end of the year? We don't change our targets. It's just we're right. We set our target once. We don't adjust them, and we're either right or wrong. And so far this year, we're wrong at 6,000. We'll see how we work out. However, 50%. We had a poll of almost 1,000 responses, and 50.7% of people said we should raise it to 6,200. So investors are very bullish overall. In fact, if you take a look at systemic positioning, which is all the computer algorithms, et cetera, you take a look at the overall professional investor, the IBD Sentiment Index, Investors Business Daily Sentiment Index, you're going to have a bigger chart to get the optimism on stocks put on. We talked about earlier this week about consumer optimism on stocks. There has been just no previous point in recent history where investors are as optimistic about stock exposure as they are right now. And a lot of that optimism has come just since the election because everybody's expecting rate cuts, which I think is a little bit interesting because, again, further rate cuts are going to be a little bit more challenging. Just in extending the current rate cuts is most likely, right? That will just extend and make permanent the Tax Cut and Jobs Act from 2017, but trying to reduce corporate taxes further from, say, 21 to 15 might become a bit more of a challenge. We'll see if that happens or not, but a big chunk of this rally is on expectation we're going to get not only an extension of current rate cuts or tax cuts, but even further tax cuts. We'll see what happens. But again, there's a lot of optimism being built in stocks right now. So again, there's nothing wrong with that. Things are very positive right now. Stocks will be positive into year end. 2025 is going to be a little bit of an interesting story because when you take a look at earnings and earnings revisions, if you take a look into 2025 from earnings revisions, the Magnificent Seven are expected to grow earnings at 17%. The other 493, a negative 3% earnings growth rate next year, giving the S&P 500 almost a zero rate of return in terms of earnings growth revisions for 2025. That's going to be hard to justify valuations at these levels. So 2025 may be a bit more of an interesting story, but we'll talk about that when we get there. But that's what you need to know before the bell this morning. When we come back, we'll pick up Danny Ratliff, talk about annuities, the good, the bad, the ugly. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, about an eon ago, I wrote a whole article, and actually, Richard and I did I think it was a Candid Coffee or something, on annuities, the good, the bad, and the ugly, and we kind of went through this whole presentation. But it's been a while since we've gone through it, and as I said, kind of at the open this morning, I'm getting a lot of emails here lately from individuals that are getting pitched annuities by advisors and things, and they're going, well, you know, this annuity sounds really good because I can get 7% a year, guaranteed, and no downside risk. If the market crashes, you know, then I don't lose any money, and that's a true statement with some caveats. And so I thought it'd be worth Danny and I. Danny's much more. I'm not licensed to sell insurance. I don't sell insurance. But Danny does. And he's licensed, so that's why I have an expert here to talk about annuities. But I've been in this business. I used to have an insurance license many years ago. I've been in this business for 40 years now, and so I've kind of developed 3 kind of just general rules over time. So when somebody, and again, you know, as Danny said before, as Richards has said before on the show, John Penn, annuities are sold most of the time. It's generally an annuity salesman trying to sell you a product. That's his job, right? There's nothing wrong with that. He's just selling you a product. But they're generally sold. They're not planned for. And that is a really important differential when you're thinking about buying an annuity. And that's because of the issues that come along with annuities that can really impact you later down the road if you're not aware of those issues. So I've kind of developed 3 rules. So when somebody comes to you and says, oh, here's an annuity. So I just kind of have a broad 3. Now there's, you know, multiple situations that an annuity may be a very good fit for you, right? But this is just kind of a broad analysis, which is, and this is just what I've seen over time. You make so much money, right? You're a very high income earner that, you know, when you contribute to your 401k plan, it's a drop in the bucket of what you can actually save. So an annuity can provide you some retirement savings outside your 401k plan. You have a lot of legal liability risk. You're the CEO of a company or the CFO of a company. And of course, post Sarbanes-Oxley, you're now personally, potentially liable for financial statements and things that you put out. Ken Lay, a good example of this from Enron, had all his money in annuities when Enron went bankrupt, right? Annuities are judgment proof. So if you have a high legal risk of some sort in your business, an annuity can make a lot of sense. Another, the kind of the third rule is that, when we're doing, when you think about financial planning, there's a issue of income needs, at the end of the day, as you go through retirement. And, it's what we call the Alpo diet, which is that you want an income stream that'll pay for everything but food, right? So your food and your other, your cost of entertainment, et cetera. But, bills are paid, house notes are paid. What's that number? What's that number just to keep the lights on in your house? So if you need a guaranteed income stream outside of Social Security to continue to pay those bills, an annuity might be a good fit for you. So again, those are just some things to kind of think about when somebody, kind of tells you need to own an annuity. But Danny, we've talked about these before, and in particular with these annuities now that we're getting, I'm getting a lot of emails on, hey, it's a 7% return. I get that every year. I have no downside risk. What are some of the things that people should be thinking about?
Well, I think that, you mentioned 3 rules, and 3 things that come to mind for me that I think that give annuities a bad rap. And they are a tool in the tool chest. We've talked about this before. Number one thing is that people don't understand them. And I think they really get a bad rap because they're not actually taught properly. And what I mean by that is that, many times it's more of a sales pitch than actually how it works together and how it works as part of a broader, bigger plan. And I think with any insurance in general, we need to take a step back and back into all of these numbers. I mean, we see it with long-term care. We see it with life insurance. We see it with annuities. And making sure that we really understand that. The other problem is, you mentioned that a lot of these guys are salesmen. And that's all they are. And they're called quote unquote financial advisors, but yet they only have one product. And so if all you have is a hammer, everything else is a nail, right? And so I've heard of many stories where a father and son go to one of these luncheons. We get questions like, how come you guys don't do these steak dinners? Like, well, that's not exactly our stick, but
I'm on a diet.
Hey, I eat plenty of steak. I don't know about you. What diet are you on today?
Today?
Yeah.
High protein, low carb, very low fat.
Fair enough. So you could eat a steak.
I'm on the Hugh Jackman diet right now.
So you still doing that?
I've switched to the second part now. So
yeah, I figured we'd see results by now, but
it's pretty tough. Go ahead.
It's been a while. I'm kidding. The other aspect of them, they're not used properly, and so we get them often where they're sold. And I could walk in, as I mentioned, a father and son going to a steak dinner, and they may have 20, 30 years difference in age, and they're sold the exact same product. And so while it can be good for somebody who's younger, and it can be great for somebody who's older, it's not always the case. And many times you would need something completely different. And so when we're not looking at it from a big picture environment, and Lance mentioned the fixed income aspect, we do have an income problem in this country, right? I mean, so many people, you look at the numbers of who relies on Social Security and the impact that has and the impact that it potentially going away. I mean, we've talked about all these things. But when we have this guaranteed income, I think this can be a nice feather in your cap if done properly and turned on at the right time. So you need to really get a really good understanding as far as how they work. And so today I want to just talk about 3 or 4 different types of annuities, how we would use them, what you should be thinking about, and where they may or may not fit for somebody. And, not being used properly, I can't tell you, Lance, how many times somebody has an annuity. 1, they think it does something that it doesn't. And 2, you see many of these with income riders. And so when you have an annuity, there's always an expense that you're going to pay. So if it's a multi-year guarantee annuity, which is a fixed annuity, it's going to give you a fixed rate of return for a specific period of time. Picture it very similar to a CD as far as the functionality, how it works. You get this rate, it's going to mature. You're going to either find something else, they'll roll it over, or they will let it sit in something that's going to pay you much less. And, that's one way. If you're looking for CD rates, that may pay a little bit more. Fixed income, that may pay a tad bit more because you're buying that from an insurance company. Now, the income annuities, there's a couple different types. There's a deferred annuity, which is going to be typically either a fixed indexed or a variable annuity. And many times we can put all these extra bells and whistles. You could put a long-term care rider on it. You could put an income rider on top of it, a death benefit. And you need to know what you need it for. But if you're going to utilize it for income, many times, and Lance, I know you've heard this, it used to be 6-7% is what they would guarantee each and every year. We need to understand if they're going to give you that 6 or 7%, you have two different columns here. You have one column, which is going to be your actual account value, which if you took the funds out, that's where it's coming from. And then you have on the income column, that's going to look a little bit different, right? That's going to go up either greater of the market or that 6 or 7%.
Right.
Now, here's where it gets a lot of people. Many times it's simple interest.
Right.
And many times it's going off of your original investment. So let's just say it's a $100,000 annuity. You have a 6% increase each and every year. Well, what does that mean? If it's simple interest and it's off the original value, that's 6%. That's $6,000 every year. And they may only do it for a very specific period of time. So a lot of times we see that after 10 years or 15 years, they no longer give you that bump. So if you're younger, thinking, wow, this is great, I get 6% every year. Well, many times it's not compounded. So you need to read the fine print, really understand exactly what that means, how that actually works. And is that going to get you to the point you think it will, where you can then therefore turn on that income and get that income for life?
Well, and I think that's a really important factor right there, is that a lot of people are being told, and this is the emails I'm getting right now, right? Is I'm being told, oh, I get 7% a year. Yes, you get 7% a year if the market gives you that, right? If the market goes down 10%, your return is zero for the year.
Well,
so
hold on, you're talking about a fixed index.
Well, I know, but right, but it's kind of the same thing. But my point though is that there's that income rider means that you take it as income, right, for the rest of your life. It's not necessarily you get that as a lump sum.
Well, that's absolutely right. So many people, I'll say, okay, well, tell me how it works. What do you think? And well, I'm getting 7%. And well, okay, you're going to walk away with 7% when it matures. Oh yeah, I'm gonna get those funds. I'm like, no, no. Let's go get your statement. Let's go get any illustrations that have been ran previously, and I want to see your contract. And you can typically look through it and say, okay, well, that's not exactly how this works. And I would say
the fine print always gets you.
Over 90% of people don't understand that, and I think it's maybe we hear that number, that 6 or 7, and we're like, wow, this is great.
Yeah.
And that's maybe all we want to hear. But I also think it's a sales tactic.
Well, it is. And I think the thing that I run into a lot is that people have no idea. They'll have like 3 or 4 riders. They have no idea what was in their annuity, right? They thought they just bought this annuity, but all these other riders, there was an income rider, there's this other, death benefit rider, whatever it is, all being put on there. They don't even realize they're paying for them because they just bought the annuity, right?
Yeah. Well, and I'll give you an example. Visited with somebody yesterday, had an annuity for a long time, going to turn the income rider on. Didn't purchase through us, had it for quite some time. And there's a sweet spot of when this needs to be turned on. But I want to talk about the difference between some of these types of annuities. Lance just alluded to a fixed index, which has no downside, so downside protection, but typically has some limited upside. There's variable annuities. We're going to talk about the cost. What does that structure look like? What are the hurdles that you may encounter when you're looking at this and how it needs to be done?
Yeah, and I think, I don't know if it's on your list, but universal policies as well.
Yeah, absolutely.
I'm getting a lot of emails on those also right now.
Yep.
All right, be right back after the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Did I tell you I got off good this year for Christmas?
How'd you swing that?
She told me what she wants for Christmas. I'm like, I am all in on this.
The Real Investment Show podcast.
A wet dry vac for our back porch.
Wow.
That's what she wants.
That is fantastic.
I know. I was like, yes, I can do this.
Same show, your schedule.
Hey, can I throw in some floor mats too for
Yeah.
the car?
Let me tell you, she would be thrilled with that.
That's fantastic.
She is.
At realinvestmentadvice.com.
She's a geek. I love her to death. I'm getting off good this year.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So talking a little bit about annuities, good, bad, and ugly. There's, again, I don't want you to walk away from this show today thinking that I'm poo-pooing annuities, because I'm not. I own one for a very specific reason. And annuities can be very good, and you should consider, and a lot of people should consider having an annuity as part of their overall wealth structure, right? We talk about diversification of assets, we talk about diversification of accounts. An annuity falls right into that category. It's a tool within the toolbox. So, annuities get a lot of bad rap for a reason, because they're generally sold wrong. And that's what Danny's going through with you today. But, we just want you to kind of understand the highlights of what's happening. And again, if you have an annuity and you want a review of your annuity, or and what you've got going on, or if you think that annuity might be a good fit for you, hit the website, send me an email. I'll get it to one of our planners here, and they'll be certainly happy to kind of review your situation. And they'll tell you if it's not a good fit for you. They'll tell you, hey, you don't need one. But anyway, you can do that at the website, realinvestmentadvice.com. But Danny, just for the break, we get left off talking a little bit about there's the emails. Here's the emails I'm getting. Why should I invest in the stock market when there's this annuity I can buy that has a 7% guaranteed return with no downside risk? And there's a lot of different types, right? There's variable annuities, fixed index annuities, fixed annuities, universal annuities. There's a lot of different types, and they all kind of get lumped into the one basket of just being an annuity. But people don't really understand the pros and cons of the different types.
Yeah, and so let's kind of go through that a little bit. So what Lance is alluding to right now is a fixed indexed annuity. And so that is generally means that we can do a couple things with it. We can go buy a fixed account with the funds, the proceeds, and that's going to grow by that. Or You can get an income rider on it as well, and that income rider will grow by that amount, like we've talked about. That we'll just use 7%. And the issue is that on a lot of these fixed indexed, you're going to be capped, or you're going to have a participation rate, meaning that you're only going to make X amount of whatever that index returns. Some may have a little bit of an advantage where they may give you 120% of something, and they limit the downside. But you have to remember. So one big thing is like, well, there's no fees with this. Well, there's always a fee. And if that fee is, it's going to be limited upside if they're going to provide you with no downside. And so your return over time, if we get into an environment with bad markets, you may be okay because you're not facing a 20, 30, 40% drawdown, and it allows you to be more aggressive in an account like this. So this is where actually I see stuff that's done wrong, Lance, is I'll see somebody go get a fixed indexed annuity, and then they will invest the funds extremely conservative.
Yeah.
And that's a problem, right? There's no reason because you have guardrails. We're not going down the highway, with a cliff on each side and, at 120 miles an hour. Yeah. You're going down the highway with, with bumpers on each side. Picture like going, if you're bowling, those big old inflatable bumpers, you have that, right? You have the guardrail there. So you're not going to fall off the cliff to the downside, and you're going to limit your returns to the upside. Have you not gotten more aggressive? So listen, I'll hear from people like, well, I can switch what I have. Well, yeah, of course you can. But you may be limited to one time a year or so many changes. You need to look at that contract. But also, I've not met anybody who can time the market perfectly both ways, and especially not multiple times. I mean, you may get it right once, maybe twice, but I mean, those guys are unicorns, right? I mean, if you're going to go all in, all out, or make really big, broad changes, or you're way early, way late, I mean, you know the story. But the fixed index, this is a problem, is that we need to be able to say, okay, when we have these guardrails, let's go ahead and take more risk on here, because if we want to make this work properly, you want to get as much out of it as you can. You want to be more aggressive. Now, that doesn't mean just go put it in, all in international or all in a very niche space per se, but we want to make sure that we're invested in the market. And so with that, Lance, we were talking about, understanding what you can do and what you can take away from these types of products. When I have a client that has an annuity or is purchasing an annuity, there may be times to change. Lance mentioned he has one since 2007.
Right.
Okay, so you and I were just talking about that off air.
Right.
And Lance may be a great candidate to make a change from what he currently has to something new, because it may not still be paying that same income. That income rider will typically stop over a specific period of time. They'll say, first 10 years, we're going to give you that 7%, or first 15. We talked about that a second ago. That is at an point. I want to go ahead and continue to get some growth on that. Now, the problem could be is that if the account has not grown and you already have, like, I'll give you an example. Let's say that account was, the value is $250,000, but the income rider, that income benefit that you could take from it is $500,000, because we've seen a lot of growth, or that number that's been going up that they're giving you each year. You're not taking that $500,000 when you put it into a new product. You're taking that $200 or $250. And so that is where, it may not be as advantageous to make that change, but you could say, hey, okay, well, let's do the math. I'm not getting any upside on this portion of it on the income any longer. How long would it take me to put it in another product to get past that and then some? So if you're younger, it may be advantageous. If you're not, or you're closer to needing the income, it likely isn't. So that's kind of the fixed index and what we see as far as what goes wrong there. Variable annuities, we don't hear or see those nearly as often, but they were very, very commonly used. And if you do those right, they can be a good tool as well. But variable annuities, picture, you're going to invest in mutual funds. They call them sub-accounts. They're going to go up and down with the market. You're going to be able to be more nimble, more conservative, more aggressive when you want. But they come with a lot of expenses. And so while that fixed index is typically, those expenses are internal, they're going ahead and, they're limiting your upside. That's where they make their money. The variable annuities are going to have a couple of different things. One is called an M&E, or mortality and expense ratio. And so, in fact, talked to a client yesterday. We looked at an old product that he had, and so I just pulled up the notes. He was getting 1.4% he was paying each and every year. Had a joint lifetime income rider of 1.2%, a death benefit of 0.3%, and an average fund expense ratio of 0.68. So that's a 3.58% expense that he has to overcome each and every year just to make $1. So that's going to be on the account. We talked about 2 columns, right? So you're going to have your account value, what you can actually pull from, and then you have your income or your death benefit column. So for that account value to actually increase, you're going to have to make over 3.58% each year. That's tough. And so many times when we look at these old contracts that you may have had for a long time, that expense ratio has really diluted the growth you could have over the years if it's something that you're going to physically walk away with. Now, the way I look at the annuities is, especially if you put an income rider on it, that should technically be for life. We're going to think about this because we're going to take this for lifetime income. You can get a joint lifetime income rider, which will cover you and your spouse. If we're going to put something aside, we're looking at it to turn it on at a specific date for the income purposes. And I don't typically want to see those moved often because we can forfeit a lot of benefits along the way. But this is expensive and this is really problematic when we think about it. If you're going to physically walk away, there's no sense in doing that annuity unless you're going to do it for a lifetime income rider or a death benefit. You want to provide a guaranteed death benefit further down the road. You see this sometimes, Lance, when somebody's like on the death benefit side,
right.
if they're not insurable.
Right.
So they can say, look, I can put this $100,000 aside and I can go ahead and get a death benefit increase of, that's 6-7% each and every year. Mm-hmm. And I don't need the funds right now, but it's a safe way to grow them to help provide, a little bit extra benefit for my family if something, happens to me. That's one way to look at it. The joint lifetime income or just lifetime income is a great way to fill in holes and fill in gaps. If we can say, hey, I've got Social Security of X amount, you may or may not have a pension. This is another way to kind of create one.
Right.
You alluded earlier that, a lot of people have used these because they're fully funding their 401k. They put those funds aside. That can be done, and I see people use it for those purposes. I would almost rather somebody look at a maybe an insurance policy, a permanent policy, because there's more tax advantages.
But we're just talking about annuities today.
Yeah. Well, you just told me to cover universal life.
I know. We'll do a whole life insurance policy.
But I just want to throw that out there. That's another way, something you can think about. Don't lead me down that trail and then tell me not to talk about it. Gosh dang.
But real quick here, just before we hit the break, I've got an interesting comment in the chat talking about, Goldman Sachs is only predicting 5% a year. And this, let me just real quick. I've had, as Danny said, I've had an annuity since 2007 that I bought, and it guaranteed me a 7% cap. And so every year I would get 7%. The problem is the market's been up like 15% on average every year for the last 15 years. So the annuity did not grow relative to the overall market because of that. But in this case, yes, Goldman Sachs only predicting 5% average returns over the next 10 years. That doesn't mean every year it's going to be 5%. So, but just assume it is. If your cap is 7, but the market only grows by 5% a year, that's all you get. You don't get 7, right? You only get what the market gives you up to 7%. So again, these are the kind of the tricks or the things you've got to be aware of. I mean, it sounds great. I'm gonna get 7% a year, but
it depends. Yeah. I mean, no, but so if in this example, if you have the market outperform that 7% or your account. Mm-hmm. You're typically going to be locked in at that higher rate.
Right.
The issue is going to be is that if that account value doesn't keep up with that 7% over time, you likely, very rarely will you ever see an account value, unless it's at the very beginning of a policy, it's a bull market, it's actually going to be higher than that because you get a down year or a flat year, that 7% stays, and then now all of a sudden it has to make that 7% plus another 7% to catch up. And, we talk about the math of loss. Even though you haven't lost, you've lost time. So kind of time value of money.
That's right. So that's what we're going through. It's just there's so many little things to this, but when we come back, we'll kind of wrap it up on this conversation. But again, if you have an annuity or thinking about an annuity, send us an email. We're more than happy to walk through it with you specifically on what you're looking at because there's so many different types, there's so many different caveats, riders, all these other types of things. If you need help with it, we're happy to do it. Just go to the website realinvestmentadvice.com, send me an email. We'll take care of you. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show. Look, the problem with annuities is they're complex, and there's a lot of things you need to understand about them. And so I know it's a lot of detail, for a radio show at 6:30 in the morning. I get that.
It's a lot to talk about at 6:30 in the morning.
It's a lot to talk about. But this is why, look, if you have questions, or if this is something that somebody's, pitching to you or whatever, be sure and send us an email. We're more than happy to walk through it with you and make sure. And the problem, again, there's so many other caveats. One thing you have to understand about annuities, and this is one thing Danny hasn't touched on just yet, is that you do need to understand that when you put money, we've talked about this before, you have three things with any investment. If it's stocks, you can have a return of your, a return on your capital appreciation, and you can have liquidity, but you don't have safety because stocks can go down in value. So, with annuities, you have to remember that you're going to give up liquidity for a period of time. If you buy an annuity, you've got penalties to come out of these things. So in a lot of cases, and not necessarily in all cases, I'm not going to say that's absolute, but in the majority of cases, you're going to give up liquidity for that annuity. So it's just another one of those factors that you have to kind of consider. Is this, if you've got money, oh, this sounds great. I can get 7% if I put my money into this. Okay, that sounds great. You're in it for 10 years though, right? So you just have to, or whatever the time frame is.
Yeah. And there's significant penalties to get out. Yeah. They call them surrender charges.
Yeah. So again, it's just those things that we're just wanting you to be careful and be somewhat educated when you go to look at annuities. And again, there's so many different flavors of these things. Everybody's come out with different types for different reasons and all this other type of things. Just, you want to make sure that you're doing it for the right reason. Understand you're going to pay for these things because the writers on these annuities all have a cost. So there's an expense to these issues, and you have a liquidity issue. So anyway, Danny, just wanted to put that out there. But
yeah, no, I think that's great.
It's a very complex thing to try to cover in 45 minutes.
Well,
right?
And there's so many different types, right? We touched on a little bit about fixed annuities or multi-year guarantee annuities that look more like CDs. Those are great if you have a specific time frame. You have cash on the sideline. You don't want money invested. You want to just try to capture as much interest as you can for that time frame. I think that's a great fit. The fixed indexed or variable, I think we prefer the fixed indexed over variable right now, and generally just the industry's kind of evolved towards that area because it does have some other bells and whistles with it. From the downside protection, you can still get an income rider. We're seeing long-term care riders, death benefits, a lot of things that can be utilized, and when utilized properly, I think they're great. One big thing I do see, Lance, is that a lot of times somebody says, "Hey, will you review this annuity?" or review my parents' annuity. And they've had this income rider. They may have had it for 20, 30 years, and they never turned it on. And so, there's a time, so the idea is if you're going to take income and have a withdrawal benefit from these types of instruments, you want to make sure that you start taking money at the right time. And what I mean by that is, number one, they're going to give you, the longer you defer your income from it, typically the more they're going to give you. So if you're between 60 and 65, they may give you 4%. Between 65 and 70, they may pay you 4.5%, and 70 plus, they may give you 5% of whatever that value is. But we've got to think about how long does it take? You're using one of these because you don't want to run out of income. So you're using these, and essentially you have to take it at a specific time. So you want to run out of your money and then rely on the insurance company to provide you with that income for the remainder of your life. So if you think about your mortality and how long you may live, now if we all knew our expiration date, we do things much, much different. But you're likely going to have to keep these things for 15, 16, 17 years sometimes for it to make sense where you actually run out of your funds and then rely on theirs. So keep that in mind. Don't wait too long to turn that income spigot on. And then there's like single premium immediate annuities. I've seen these used for somebody that may retire early. They want guaranteed income until they start taking Social Security. They want to delay until 70, or they have specific needs that they have. Maybe you have 2 homes and you say, you know what, I'm going to have these 2 homes for the next so many years. I'm going to sell this in 10 years. And that may be, to cover those expenses, have that guaranteed, have the remainder of your funds invested in other areas that are volatile. That's one way to look at it. There is, sometimes you need to protect yourself from yourself. And, I have clients looking back that I wish they would have done a pension. They would have taken the annuity, people with really, with quite a bit of net worth, but they were their own worst enemies, meaning that they spent too much. And they say, oh, this is a one-time deal. It's just this year. And then it's the next year. And it keeps going. And you're like, oh man, hey man, we've got a problem, right? This is not a one-time deal. This is a trend. And, that's where if you know yourself, or if you spend too much, or you have a difficult time saving, if it's not on autopilot, it's a good way to help kind of set some guardrails for your funds as well. Now, I will tell you this. I've listened to a lot of radio shows. My kids probably think we're nuts because, weekends are great to listen to boring financial shows. And, I've heard a handful of people say, oh yeah, you could put everything you have in an annuity. No. Like Lance just mentioned, you're giving up liquidity. There's going to be large surrender charges. We want a portion, and we want it to be very specific as far as what its objective is and how we're going to use it within a bigger, broader financial plan. And so when they're not used properly, that can become a big problem. And, it's a hurdle to overcome because they are expensive a lot of times. And so know what you're in, know how it works. We're always happy to review, oversee those, kind of give you an idea of what it looks like and break it down, because I think that's where, a lot of people just don't quite, they don't understand.
Well, and again, it's just, there's, the reason that these are sold more than planned for is they're a very high commission product.
Correct.
So, and this is the one thing that, we didn't really touch on yet. Dinners. This is why you get steak dinners. And this is why there's literally, I've run into a lot of certified financial planners, right? And all they sell is annuities. They do a financial plan and they put everything you have in an annuity. And the reason is they're a very high commission product and they get paid a lot of money. This is why you see annuity salesmen, they drive Mercedes and Ferraris and those type of things. But again, this is why you should always ask yourself the question, as we talked about this before. We did a show on private equity a few months ago, talking about, ask yourself one question: why am I so lucky to be given this product? And just make sure. And again, private equity is good. If you invest in the right private equity, you can make a lot of money. But ask yourself the reason: why are you being pitched this product? Why are you so lucky to be pitched this product? And just make sure you understand the risk that you're taking, because there's nothing that's risk-free. And as we talked about before, you can have safety, liquidity, or return. You can't have all. You can have 2 of the 3, but you can never have all 3. And there's a cost to everything that you do. So just as Danny was just pointing to, just you want to make sure that you're doing the right thing with your money for your personal needs. And I can't tell you how many people I've met with, they were sold an annuity and now they're trying to figure out how to get out of it because it's completely upended their whole life. They've got all this money in an annuity and they're looking at 6% charges to get out of it, which is going to put them below their initial principal value that they put in. So, they're really struggling with that. And again, it's just they didn't understand what they were paying for going in, and now they realize, and the market's, of course, taking off, and they're like, well, how do I get that? And you can't, right? You're stuck.
Well, especially that's why we don't put everything into something like that. And they need to be planned for. I mean, look, we can do annuities. We're not, we're certainly not annuity people, and what I mean by that is that, it can fit for the right person at the right time. It's not for everybody. And so not everybody will need one. Sometimes it's peace of mind. Mm-hmm. Sometimes it's that guaranteed income. Sometimes it's the death benefit. One other thing I do want to bring up is like, you visit with somebody who's had an annuity for a long time. I've had clients that we did annuities back in mid-2000s. Like, why don't we do more of these? I was like, well, because you don't put it all there. But it's been great from an income perspective. Now, when you see inflation, though, at give or take 25% over the last 4 years, all of a sudden you're like, whoa, that payment, somebody's been receiving that payment for a long time. Mm-hmm. If you don't have an inflation rider that actually increases that a little bit each year, your benefit, and many policies don't even offer that. Some do. They're underperforming in another way, right? Their actual real return is much less than their income that they expected, just doesn't go as far. And so that's another thing that you need to be considering when we look at these annuities as a whole.
And again, I bought my mom an annuity when she was much younger in life, and she's totally screwing the insurance company now because she's like 91 and still going. Yeah, and so the real way to win at the annuity game is to take care of your health, eat right, diet, exercise, and outlive the actuarial table age-wise.
That's right.
Because now it's all on them.
Well, that conversation we had with a client and their CPA who sells annuities, and we were talking about. I said, well, all right, well, here the way I figured it's going to take you 15 years to get out of this, and it was kind of just rough math. And he's like, no, it's going to be 16 exactly. He's like, so think about what is your life expectancy. And those actuarial tables are right there, right? Yeah. He's like, so you got to beat that now. You got to be on the other end.
That's your hurdle. Yeah. That's your benchmark. Your new benchmark is that actuarial table.
That's right. And so that's the key, is that we have to understand that, we look at Social Security. I visited with somebody yesterday on that, and, it's like, all right, well, here's your break-even point. If you take it now versus if you delay, your break-even point for them was like 81 and 77. This is where you're in the money versus taking it now. Yeah. Well, I don't know if I'm going to live that long. Well, nobody does. But, they're going to bet if you take it that you're not, and you're going to bet that if you delay, you're going to have to live at least that long.
Yeah, exactly.
For it to make sense.
Absolutely. All right. About 30 minutes from now, we get the CPI report. Whole market will respond to that today. Outside of that, not a lot of earnings left. November the 20th, right around the corner, is NVIDIA. Of course, that's going to be the last really kind of big earnings announcement coming out. We got Walmart coming up, I believe, next week as well. But we're getting to the end of earnings season as well. So, Danny, thanks so much today. If you have any questions about an annuity, if you have one, if your parents have one, you need it reviewed, thinking about buying an annuity, is it the right thing for somebody trying to sell you an annuity? Hit the website, realinvestmentadvice.com. Just send us a question. We're happy to help you out with it, whatever we can do. Realinvestmentadvice.com. Make sure and like and subscribe to the YouTube channel. We certainly hit that like button. We certainly appreciate that. That helps us a lot. And again, get by the website. Michael Leibowitz's new article is out. He'll be here tomorrow to talk about that as well, right here. And we'll talk about the CPI inflation report tomorrow and what that means for the Fed. That's on tomorrow's show with Michael Leibowitz. Have a great day. We'll see you back then.